Welcome back to The Explainer. Today, we're unpacking our latest daily brief about the financial markets. And honestly, we're looking at a fascinating, almost mind-bending mystery that's playing out right now in the global economy. I mean, if you've been following the news, you've probably felt a bit of whiplash lately, right? The headlines are just screaming about geopolitical crises, and yet the markets seem to be living in a completely different reality. Okay, let's dive into this.
So, this is the million-dollar, or well, actually, the multi-trillion-dollar question we have to ask ourselves today. Why on earth are stock markets soaring to all-time highs while global risks just seem to multiply by the day? It's a massive disconnect. We've got absolute chaos in the headlines, but this incredibly bullish, super optimistic attitude on the trading floor. How do we even reconcile this?
On one side of the ledger, you've got geopolitical fears. We're talking international conflicts, massive real estate crashes in major economies, and shrinking bank reserves. But then, think about the other side. What's really interesting here is how the market reality completely defies that fearful narrative. We're seeing record stock highs, aggressive institutional buying, especially over in the tech sector, and really solid economic growth. It honestly feels like two completely different worlds.
To solve this mystery, we need a roadmap. So first, we'll look at the global market paradox. Then, the Middle East oil clock. From there, U.S. liquidity under the radar. After that, China's real estate crash, which leads us right into the great global imbalance. And finally, where the money flows.
Section 1. The Market Paradox. Flawed Predictions.
Let's start with our first major suspect, which is the completely wrong forecast for the U.S. economy over the past year. Do you remember the beginning of these recent global conflicts? The overarching narrative was all doom and gloom. Early fears pointed directly to a guaranteed U.S. recession and a massive private credit crisis that was going to just choke the money supply. But the actual data? Those fears were completely off base. The U.S. GDP is actually growing at a really solid rhythm of about 2.5%. So, instead of a panic, we are witnessing extreme investor optimism and just massive institutional tech buying. That predicted collapse was, frankly, a total illusion.
Section 2. The Middle East oil clock, geopolitical tensions.
If the U.S. economy is that resilient, what about outside pressures? Well, to understand this, we have to put a timeline on oil production in the Middle East. There's an actual ticking clock behind all those scary headlines. If production gets disrupted, regional producers hit two major limits. First, they only have about 15 to 22 days of physical oil storage capacity. After that, they literally just run out of physical space to put the oil. But, and this brilliantly illustrates the real situation, consider their financial buffer, 3 to 4 months. Because they were allowed to export massive volumes previously, they've built up this huge war chest of cash. So, they can financially survive a disruption and suppress any domestic economic pain for roughly a quarter of a year before taking a real hit. We're essentially looking at a 3 to 4 month window of potential market friction.
And we're definitely seeing that friction in the data. Oil prices recently broke through a major resistance level at $102, and the current trend suggests a target of around $108. But keep in mind that inverted future structure. In financial jargon, this is called backwardation. It basically means the market views this price spike as a temporary issue, not some permanent new reality. However, make no mistake, the short-term trend is undeniably upward, and that definitely creates pressure. But here is exactly why the West, and specifically the U.S., can endure this pressure. Consider these resilience factors. The U.S. is currently exporting oil, natural gas, fertilizers, and helium at absolute historical highs. It's acting as a massive buffer against these global shocks. Just consider this. Recently, natural gas prices in Texas actually went negative. Think about that. They had so much of it, they essentially had to pay to get rid of it, while other parts of the world were paying a massive premium. This level of energy independence is just a huge shield against that Middle East oil clock.
Section 3. U.S. liquidity under the radar. Following the money.
While the economy looks incredibly resilient on the surface, we always have to follow the money. And that brings us to domestic flows and Federal Reserve liquidity. I want you to focus on this massive number, $250 billion. That is the amount of liquidity that was recently withdrawn from the U.S. Treasury's account at the Federal Reserve. Big money is moving behind the scenes.
And that leads directly to this next figure. Total U.S. bank reserves have actually sunk below $3 trillion. This indicates a quiet but very, very significant shrinking of liquidity happening right now in the financial system. The actual pool of available capital that oils the gears of Wall Street, it's contracting.
Let's move to and see how this builds into a potential short-term risk. Step 1.
As global energy prices rise, capital leaves the financial markets to pay for real-world goods, things like manufacturing, logistics, raw materials. Step 2. As a direct result of that, financial sector liquidity shrinks, which is exactly what we just saw with those dwindling bank reserves. Step 3. You combine that shrinking liquidity with the extreme investor optimism we talked about earlier. Everyone is super bullish. They're buying up tech stocks, and literally no one is hedging their bets. This creates a classic textbook setup for a short-term market dip. Just a little reality check.
Section 4. China's real estate crash. Domestic economy.
Now, a short-term dip in the U.S. doesn't explain the massive, persistent upward trend of the global markets. To solve that, we have to pivot our investigation across the globe to our third major factor, the deeply restricted domestic economy in China. It is quite literally a tale of two economies. The clear winners right now? Export manufacturers who are just booming, and the government, which is raking in massive tax revenues from all that production. But consider the losers, everyday private citizens and real estate investors. Private consumption is being structurally restricted, meaning the everyday citizen just isn't feeling the benefits of that booming production.
And the pain for that everyday citizen is profound. Listen to this figure, 20%. That is the staggering amount of wealth that Chinese citizens have lost in their crashing domestic real estate market over just the last 5 years. For a culture that historically parks its life savings in property, this is a devastating wipeout. They have completely lost faith in their domestic real estate market.
Section 5. The Great Global Imbalance. Macroeconomic forces.
This brings all our puzzle pieces together. The pain in China's domestic market is creating this overarching macroeconomic force that is basically dictating global market behavior. We have a massive tension here. On the domestic side, property values are crashing, citizens refuse to consume because they feel poorer, and instead they are just hoarding their savings or aggressively buying gold. But on the export side, production is booming and trade surpluses are expanding despite global tariffs. So you have this massive amount of wealth being generated by exports, but the citizens absolutely will not spend it at home.
So, the crucial point is, this creates a structural trade imbalance. Because China is producing vastly more than its citizens are allowed to, or are willing to, consume, an enormous mountain of excess capital is being generated. And because they want to invest it in their own crashing real estate market, that capital is literally forced outward. It has to go somewhere. The imbalance is just too massive to be contained within one country.
Section 6. Where the money flows. Global excess savings.
This leads us right to our finale. We just need to track exactly where all these global excess savings inevitably end up, and this pipeline definitively solves our initial paradox. Step 1, massive excess savings are generated by Eastern exporters. Step 2, there's a total lack of safe domestic investment options because of that crashing real estate market. Step 3, that absolute tsunami of capital has to go somewhere, and it floods into the only places big enough to absorb it. Deep, liquid, Western financial markets. This is exactly why stocks are soaring despite all the geopolitical chaos. It's not just about local U.S. economics, it's about a structural global imbalance forcing massive amounts of foreign capital directly into Western equities.
Which brings us to this really powerful takeaway. Volatility is the tax we pay for investing in long-term trends driven by global liquidity. It's so true. Yes, we might see short-term dips because of shrinking U.S. bank reserves or a 3-month oil shock in the Middle East. That's just the tax. But the underlying long-term trend, that's driven by an unstoppable tidal wave of global savings seeking a safe haven.
So, I want to leave you with this final provocative thought. Next time you see a scary headline about a regional conflict or a slight dip in domestic liquidity, ask yourself, as long as massive global imbalances are forcing trillions of dollars of excess capital into the financial markets, can any short-term crisis truly derail the long-term trend? It completely changes how you view the daily news, doesn't it? Thanks for joining me on this explainer, and keep your eyes on the real flow of global liquidity.